we work in Zoom. So if you haven't been on Zoom, welcome to it. I'm sure many of you have. So for this event, we're going to work this way. You'll see that there is a toolbar somewhere on your screen if you're in Zoom. And if you want to ask us a question, click into the chat window. So click on chat, it'll open up a window and you can type there. You can type to all, or you can type to Lynn Yanyo, or you can type to Lori Nicolini and she'll forward it back to me, to Lynn Yanyo. And I'll be monitoring all the questions that come in the chat window today. So just chat with everybody or chat with me. If you'd like to speak, you can raise your hand. There's a little icon in there in the participation window, and you can choose to do that. And I will be tracking all of the questions as they come in. So as you think of them, feel free to just type them into the chat window and I'll queue them up for Robert at the right time. Okay. Today, I'm so excited that we get to meet again with Robert Fry. Robert is a corporate economist. He formerly was with DuPont, and he's ranked as one of the top 5 economic forecasters by the Wall Street Journal. If you've been around B2B very long, you recognize his name. After retiring from DuPont, he continues to analyze and produce forecasts of the global economy for business decision makers and those that subscribe to his monthly newsletter, which is the Current Economic Conditions. And if you would like to learn more about getting that newsletter, please let us know. I've now been following it every month and I find it not only informative, but somewhat comforting. So he's got a great take on most things and it helps you to really be able to see behind what's going on. So Robert is here to reprise the insights we got about 6 months ago from this economic health crisis that we're in and that we continue to be in. His past reasoned and data-driven scenarios were comforting to me and pretty spot on. I don't know if he's going to revisit those or not. So I'm really excited to see what we're going to learn, hopefully as good news. So before we get started on that though, we're going to do some polling. Right? So Lori, would you put up the first poll? And this is a poll that we've been using for every town hall since we started the town halls, which was somewhere in March of this year. And I'm not seeing that poll. Do I need to stop sharing for you to do that, Lori? Let's see.
Which one do you want the temperature check?
Yes, please. Let's do that first one. Okay, so this is the one that we've been asking everybody. If you were hit with us in March, you understand we were asking about a temperature check. So how are we feeling? I really feel like it's all doom and gloom and I'm depressed and it's still only going to get worse. It's gloomy and doomy, but I guess I'm okay. It's kind of bad now, but I can see the clouds lifting. It's been stressful. I'm handling it. I'm taking the right steps. I think things are getting better, or I've got this. I see a light at the end of the tunnel. And we've tracked this over the months together. So I'll give you all a few minutes to just see if we can get to maybe 80% voting. And you know, we haven't done it weekly. I'm sure this would have even transitioned weekly, but it is fascinating to see the variety here. Let's give it another, we're not quite at 80%, so we'll wait another couple of seconds. Please weigh in. I really do appreciate that. And Lori, you can show this poll result for everybody. It's interesting, but not different, that the highest chosen one is the stressful. I'm handling it. I'm seeing things get better. But that number has been higher in the past. So there was a point when it was more like 60% of you said that. And there was a time when none of you would have said it's all doom and gloom, and maybe somebody would have said it's glooming and doomy. And there's far fewer of the I got this in the 20% scale. So I don't know what that really says, except that we're not out of this yet, and we're starting to get tired perhaps. All right, so let's pass that one by. And the other two that I want to do are 2 pieces of data that we were wanting to gather for Robert. So we're going to gather it here from yous that are attending rather than previously. So the first thing is to understand inventory. So if you know this for your company, what level of inventories are you seeing in your supply chain? That is, there's not enough and your suppliers are holding you back? About right, so you're able to produce what you need to produce? or too much. You're into the whiplash effect and now there's more here than you need to, and you're not getting the orders that you want to pull it through. So we'll wait for about the same level of participation. It's starting to really pummel in now. Thanks for thinking it through and voting with us. Give it another couple seconds. If you're just joining us, thanks for coming in and participating in our poll. All right, looks like it's kind of slowed down. Let's show these results, Lori. So the comforting thing here that our inventories are about just right. A few of you are struggling that things aren't coming through fast enough, and a few of you might have a little too much, but a large proportion of you think it's just right. So I think that past practice might have helped us here, but I'm comforted by that. Let's do the next one, which is just a yes or no or up or down vote on hiring. Is your company having trouble hiring workers? Some trouble, no trouble. And we left it that way because we really wanted to just break it up in half. Either you're having a hard time finding people or you're not. This is good, all right? So we'll wait till we get about, so we're at about 60% voted. See if we get any more in. Okay, so go ahead and show this one too, Lori. All right, so about 60% of you say no problem, but about 40% of you say, yeah, we're having a little trouble finding good people or for whatever reason, but we can debate that afterward. Okay, thank you for those polls, Lori. I'm gonna go on and just talk a little bit about what's gonna happen after this, and then I'll go back to that. You can contact us at any point. I'll put this back up later, but you feel free to reach out to Robert with questions, or Rand or myself or Becky Williams after the fact, or at any time that you need help from us from ISBM. And then what's coming up here is we've got 2 more events during the daytime, like this webinar. Tomorrow, we have Amy Belliette, and if you're in communications or if you're marketing a product that has some challenges in terms of communicating complicated information, you're going to want to join us tomorrow with Amy. She's got some amazing ways of visualizing data and making it stick in people's heads. So you're going to want to see that. Next week, we have Eric Jochimsthaler, and Eric is going to be talking to us about his new book, The Interaction Field. I'll be interviewing him, and we'll have open time and discussion, but his new book is fascinating and really an interesting way of thinking about how we interact with other companies. So you want to put that on your calendar as well and sign up at isbm.com. And then next year, we're setting a date for our Marketing Excellence Roundtable, which most of the companies that join us as members have at least one participant that joins us. It helps us see where you guys are going and also help companies move themselves, move the needle on marketing improvements and capabilities. So you'll want to check that out toward the end of January is the date we're setting. There's one more course on our calendar, New Product Blueprinting, and that is this month. And then of course, if you've missed any of this, or you want to share any of it with anybody in your company, everything we have is recorded, and you can find that through the library on isbm.com or through B2B Pulse. Okay, that's our little bit there. I'm going to go back to this slide, and I'm going to hand this over to Robert now. So Robert, I'm going to stop sharing, and I'm going to let you put your slides up.
All right. There we go.
Awesome.
Thanks, Lynn. It's a pleasure to be able to join you again today. The calendar says it's October 6th. I think it feels more like March 226th or something like that. We've been in this mess for a while, but you know, we're going to get through it sooner or later. I'd like to call your attention to 2 pieces of information here. One is my website, robertfryeconomics.com. You can find out more about me and my company there, and you can subscribe to my newsletter there. If you subscribe to my newsletter between now and the end of the year, I will extend your subscription through the end of 2021. So if you subscribe now, you'll get 15 issues for the price of 12. If you want a copy of my slides, please feel free to email me at the email address there, and I'll get them out to you. All right, this is not moving. Hang on, let me see what I can do here.
Sometimes it's just a matter of clicking on the screen.
All right. I need to move the part where I'm seeing everybody's faces so that I can, there we go. Okay, now we're working. All right, first a disclaimer. This basically says that economic forecasts are sometimes wrong. So this is not meant to be investment advice. And because economic forecasts are sometimes wrong, someone came up with this definition for economics. We spent a lot of time explaining why our predictions didn't come true. This year, more so than in any other year of my professional career, I think I have a pretty good excuse for why the predictions I made, say before the second week of March this year, didn't come true. But if you think back, this is where we were in February, about February 19th, when the stock market hit what until recently was an all-time high. The economy was growing. It had been growing at about a 2.1% annual rate, but it was showing signs that things were going to pick up, even though the unemployment rate was at a 50-year low. Employment growth in the first 2 months of this year was very strong. Median family income grew in 2019 by the biggest percentage change ever. So the gains were being spread through the economy to a much greater extent than over the prior decade. And it looked like things were picking up. Housing is a reliable leading indicator, and the housing sector was at cyclical highs after some weakness in 2018, 2019. Oil prices or oil production at record highs and still rising. So economy looked pretty good, and then COVID hit, and this is what GDP did in the first and second quarters. A 5% annualized decline in the first quarter. That was worse than all but one quarter in the Great Recession. And then almost a 32% decline at an annual rate in the second quarter. Keep in mind, those are annualized rates, so GDP did not drop 31 point something percent. It dropped 7 and change, and that annualizes to 31 to 32. But still big declines. That was a record decline. It was more than 3 times the prior record, which was in 1958. And you can see that year-over-year growth in the second quarter was about -9%. So very bad quarter. It helps to look at the level of GDP and not just changes. And you can see the decline in the first and second quarters was probably twice what we saw during the Great Recession. And remember, the Great Recession was the worst recession since the Great Depression back in the late 20s and early 30s. And so this one was much worse than that. So a pretty bad hit in the first 2 quarters. This is how some people have defined recession. I'm not sure I would use that description this time. I'm sure many of the people that have been hurt by this would take issue with this. So I'm not endorsing this definition, but I'm pointing out that this recession is very different from prior recessions. You can see a big hit to consumption. It was down about 17% year over year in April. It's still down about 3% from a year ago in August. But one of the big differences between this recession and prior recessions is that disposable personal income has actually been higher than it was in 2019. That's because the fiscal authorities rushed through a relief bill, or more than one relief bill actually, very quickly. And that has kept disposable income higher this year than it was last year. Very unusual for recession. The other big difference between this recession and prior recessions, in most recessions, most of the impact is felt in investment goods and consumer durables. They're the more cyclical sides of the economy, along with housing. In some recessions, services haven't even declined at all. They usually decline much less than goods, and sometimes not at all. In this recession, services have borne most of the impact. Restaurant meals count as services. Food you buy at the grocery store and eat at home is counted in goods. That's part of it. Also, services include a lot of entertainment, travel. Those parts have gotten hurt. The most interesting thing on this chart, you'll notice that goods have bounced back so much from their decline in March and April that they're actually at record highs, or in July we're at record highs, higher than before the recession. So there's three things at work here. One is during March and April, people couldn't go out and shop, and so pent-up demand built up, and they had to go out in May and June and July and August and buy the things that they would have purchased in April. So pent-up demand is part of that. That will get worked off pretty quickly. If it were all that, I think goods consumption would go down. Part of it is the fiscal stimulus that we talked about on the last slide. A lot of households actually have more money than they had before the recession, and they're spending that on goods because they can't go out and spend it on services. It's not safe. So that's accounts for part of the jump in goods consumption. To the extent that's the case, if we don't get another stimulus bill, that is the spending on goods is going to have to fade. People no longer getting as much of the supplemental unemployment insurance benefit. The third thing is people are just shifting spending from services to goods. They're not going to the gym anymore. They're buying a Peloton. They're not going on airplane trips. They're buying an RV. They're not going to buy an RV every month. They're not going to buy a Peloton every month, but they're not going to shift back to the gym right away either. And they're not going to trade in their RV for plane tickets. So that impact, I think, is more persistent, more permanent. This slide shows pretty much what the prior one did, that the impact of this recession has been borne heavily by services. In this case, it shows you how far spending at food services and drinking places went down, and that it is still well below its pre-recession peak, whereas the rest of retail sales, excluding food and drink, is actually well above its pre-recession peak. So people are spending on retail, but they're not spending on restaurants and bars. Employment dropped about 22 million in March and April. It's clawed back about half of that. We're still down to about 11 million jobs from before the recession. The unemployment rate jumped to about 14.3%. It's down under 8 right now. It's got a 7 handle. So it's come down quite a bit, but it's still very high by historical levels. But at least it's below the peak level of 10% that we hit at the end of the Great Recession. The best weekly measure we have of the economy is initial claims for unemployment insurance. That peaked at almost 7 million a week versus a prior record high of 695,000 a week back in 1982. It's come down quite a bit, but it's still above that 1982 record high. So still a lot of people filing for unemployment insurance every week now. So people are still losing jobs, not just that they haven't gotten their jobs back, but they're still losing jobs. Industrial production and manufacturing dropped quite steeply, about 20%, and ended up lower than it was at the very depths of the Great Recession. It's gotten 60 or so percent of those losses back. So we're seeing a pretty quick rebound in the manufacturing side of the economy. A lot of that is explained by what's going on with motor vehicles. Motor vehicle production was essentially shut down for about 8 weeks in April. There were almost no vehicles produced in the United States. And so they've had to try to restock the lots. In some cases, there were so few cars on the lots that dealers were parking their cars diagonally to make it look like they had more stock than they really did. So they've had to try to catch up for that and restock the dealers' lots. So you've had.
No, that was just from the coffee. Just from.
Is somebody asking a question? Oh. Okay, and auto sales not quite back to the pre-recession peak, but they've surprised on the upside the last few months. Used car sales have been extremely strong. People who used to take mass transit to work, who don't think that's safe anymore, have purchased used cars. They can't purchase used cars unless people trade in their used cars for a new car. So we've had some pretty decent new car sales as well, but still not back to the pre-recession peak. So summing up, this was the worst recession since the Great Depression in terms of depth. April was the worst month that I think any of us have ever seen in terms of employment, retail sales, industrial production, unemployment. The second quarter decline in GDP, also the worst ever. And even if we get a good bounce back in the second half, the annual decline in GDP is going to be the worst we had since the wind down from World War II in 1946. But unlike most recessions where there are no winners, where every industry contracts, this recession has been marked by extreme losers and some winners. The winners tend to be online retailers, tech companies, grocery stores, and their shareholders. Stock market has exceeded its pre-recession level. The losers, restaurants, travel, entertainment. Perhaps the biggest losers are landlords whose tenants just simply aren't going to be able to afford to pay their rent. My favorite quote, the Nobel Prize in Physics was actually awarded this morning to three physicists, but this is the guy who won the Nobel Prize in 1922, and he pointed out that prediction was difficult, especially about the future. But I'm an economic forecaster. I can't avoid forecasting. I've got growth in the third quarter at 31% at an annual rate. We'll get the first estimate of that the last week in October. I'm maybe a little below consensus because I think a lot of forecasters are forecasting higher government spending on goods and services than I am. Although I think they'll be coming down in the coming days because it looks like the trade deficit was bigger than they were forecasting. But still almost a 4% decline in GDP this year. After this quarter, though, we get a distinct slowdown in growth, partly because the fiscal stimulus has run off, partly because we've picked the low-hanging fruit, the things that can be done safely, we're doing again. So we've gotten the initial rebound, and then we're going to get slower growth until we get a vaccine, and then the services sector will pick back up. And this is what it looks like when you look at level terms. So you get that initial bounce back. Keep in mind, if you have a 30% decline and then the 30% increase, you're still down 9% from where you started. So you do not make it all up by going down 30 and coming back 30. So we get this nice bounce back in the third quarter, fourth quarter, first quarter, slower growth. And then if we get a vaccine next year, we get a few quarters of stronger growth to get us back up above the pre-recession peak and towards the old pre-recession trend. So economists tend to describe recessions and recoveries with letters. A typical recession recovery is a very symmetrical V. You can also have a U where you linger on the bottom, a W where you have a double dip, the dreaded L where you don't recover. I think this is sort of like a script V. It looks more like a V than any of those other letters, but it's not symmetrical. We're going to come out of this slower than we went into it. not quite the Nike swoosh, but not a symmetrical V. I'm speaking of the recession, I think in past tense now. The way economists define a recession, the recession only includes the time period where economic activity is contracting. Once you hit bottom and start to recover, you're no longer in the recession. If you're running a business, if you're unemployed, you probably use a different definition of recession, and you probably think you're still in a recession. I think economists need to be sympathetic to that, but at least the way the National Bureau of Economic Research is going to define the recession, it probably ended in April or May, and this was the shortest recession on record, not just the deepest. As I said, growth was slow in the fourth quarter. That's showing up already in the monthly and weekly data we look at, especially on employment. And then we'll see an acceleration next year. The pace of the recovery is going to depend on a number of things. First of all, people have to figure out what can be done safely and what can't be done safely. Not just individuals, but governments need to figure that out. Right now, it seems like too much behavior and too much government control is determined by political affiliation. So you have some states where all the bars can open with no restrictions, and you have others where the garden center at Walmart can't be open, even though that's outside and is probably the safest part of the store. So, hopefully we'll learn what we can do safely, and those businesses will open, and the things that can't be done safely will remain closed. But even if we learn what can be done safely, we don't get the full economic benefit out of that unless we can shift resources from activities that can't be done safely to those that can. I would argue most home construction can be done safely. If you're at opposite ends of a 2x4, you're about 8 feet apart, and you're probably wearing a mask anyway. So I think home construction and renovation can be done safely, and yet there are labor shortages all up and down the building materials and construction supply chain. It would be wonderful for the economy if some of those unemployed waiters and waitresses and bartenders, if they know how to use a hammer or a saw or a spackling knife, if they would look for a job in construction, that would really help the economy out right now. Another thing that determines how fast we'll recover is the number of businesses that go bankrupt and how that spreads through the financial system. The Fed will do everything it can to keep it from spreading through the financial system, but I don't think their ability to do that is unlimited. And finally, the pace of recovery is going to depend upon fiscal and monetary theory. It seems like even formerly conservative people are acting as if modern monetary theory is correct and that we do not need to worry about deficits. I would argue in the short run that's probably true, but it's true until it isn't anymore. And at some point it'll cease to be true. But right now, it's probably better to err on the side of more fiscal and monetary stimulus rather than less. But some people would have a different point of view. My fellow Marylander, H.L. Mencken, would probably be a little more skeptical of fiscal policy right now than most. Speaking of policy, the Fed has changed their inflation target to a 2% average over time, which means that they're willing to let inflation run above 2% for a while to get the average up, since the average up to 2% since it's been running below 2% for a while. That means they will keep their policy interest rate, the federal funds rate, in a 0 to a quarter point range for a long time. The median estimate from the voting members of the Fed is actually that they will keep that rate in that low range through the end of 2024. So do not expect interest rates to rise much in the short term. The Fed is also buying government securities, mortgage-backed securities, and even some corporate debt. And so their balance sheet has expanded quite a bit this year and probably will expand more before the end of the year before it starts shrinking at some point next year. The stock market has responded to the monetary stimulus. I think that's probably the biggest reason why it's responded. And it hit record highs a month or so ago, and it's back up now above where it was back on February 19th. So a lot of this is monetary stimulus. Part of it is, keep in mind when I talked about winners and losers, the winners tend to be large publicly traded companies. Most of the losers are small privately held companies, which are not reflected in the S&P 500. So this is big publicly traded companies. They're doing much better than small, say, mom and pop restaurants. One of the positive parts of the economy, which is responding quite well to the lower interest rates and the monetary stimulus, is single-family housing. Single-family building permits, which is the most important number in the monthly housing construction report, is up to its highest level since 2007, before the Great Recession. This is a leading indicator for the rest of the economy. So this indicates that growth is going to continue positive going forward. Multifamily housing not doing nearly as well. People are trying to move out of the cities and into the suburbs, and so not nearly as much demand for apartments and condos as there was before. And this is just that single family building permits number, far below where we were during the housing bubble back 2005, 2006, but still the best we've seen in about 12 years. Another thing that makes me think we're going to see some pretty decent production on the good side of the economy is that inventories have been drawn down quite a bit. That's probably okay at the retail level because a lot of retailers are not doing very well. They've been replaced to a large extent by online purchases, and those are sold by wholesalers for the most part. So I would argue that the wholesale inventories that have been drawn down need to be rebuilt. And to rebuild those inventories, you're going to have some combination of greater industrial production in the U.S. and larger imports to get inventories back up to normal. We've already seen something of a pickup in new orders for non-defense capital goods, ex-aircraft, which is a monthly proxy for the quarterly investment number that's in GDP. The red line is the quarterly number, investment in equipment in GDP. The black line suggests that the red line is going to turn back up in the third quarter. Amazingly, the orders number is actually higher than it was a year ago. So this bounced back actually quite quickly. This is my leading indicator model for industrial production. Did not call this recession, certainly not to the extent. It was calling for some weakness in industrial production, but was not calling for a full-out recession, just because this was caused by something that was not very predictable. But this suggests that we will have positive year-over-year growth early next year. I really don't think that happens until March, but March will be growing off a very low level. So we'll be back into positive year-over-year territory next March. And this is what the level of industrial production in U.S. manufacturing looks like. Again, it's one of those asymmetrical script V's. Gets us back to the pre-recession peak about the end of 2021, a little before we get back to the pre-recession peak in GDP, which is in early 2022. I spent many years in the chemical industry, so I still follow chemicals, excluding pharmaceuticals. Not nearly as big a decline in this industry in this recession as in the last recession. Part of that was due to the fact that a lot of the decline the last time had to do with some shifts from US production to the rest of the world. That's some of that may be coming back. The hit this time around was not nearly as bad as in the last recession in this particular industry. Chemical prices track the price of oil, even though most chemicals in the United States are made from natural gas liquids rather than from oil. The rest of the world makes those chemicals from naphtha, which is a crude oil derivative. And since that's the marginal source of supply, that's what sets the price. Oil prices have been weak, in the low 30s, the high 30s lately, and probably will take a while to get back up to the levels they were at just a couple of years ago. Trending up gradually, but probably below $50 a barrel for a few more years. Natural gas prices also very soft right now. And because oil prices are so weak, we've seen a huge decline in the drilling rig count. I actually had to redraw the scale on this chart when the rig count fell below 300. It's picked up the last 2 weeks after oil prices got up to about $40 a barrel, but that's after a huge decline. So we've gone from 2,000 to below 300 in the last few years. And because of the decline in drilling, that's already showing up in oil production. With fracked wells, you get a lot of production initially, and then it tails off fairly quickly. So when you stop drilling, it doesn't take very long for production to start going down, and that's what we've seen since this peaked about February or March. With oil prices soft, that helps keep inflation down. The Fed has a target for inflation of 2%, and it's still well below that. And as I said earlier, that target is now an average over a long period of time. So to the extent that this is below 2% now, that means this has to run above 2% at some point down the road. It might take the Fed a while to get inflation above 2%, but they plan to do that. And the longer it takes to get back to 2%, the longer they're going to let it stay above 2%. I want to take a quick look at the rest of the world. This is industrial production, construction, both for the world and for the advanced economies. And you can see big declines and then a pretty strong snapback. And this is what it looks like in year-over-year terms. So the emerging economies, and China has the biggest weight there, are almost back to where they were a year ago, whereas the advanced economies are still down about 7.5% from where they were a year ago. China felt the impact of the pandemic a couple of months before we did. So in January and February, and those 2 months are averaged for statistical purposes in China because of the variable timing of the Lunar New Year. Officially, their industrial production was down about 13%. The measure I prefer was down about 22%, but production is now running up 5 to 7% from where it was a year ago. So a very strong snapback in China. Normally, the Japanese economy responds to what's happening in China because Japan sells a lot of capital goods to China. But despite that quick bounce back in China, the weakness in the rest of the world and in demand in Japan itself has really held back the rebound in Japanese manufacturing. These are data through August, so not getting the sharp bounce back we've seen in other parts of the world. I've actually seen a much stronger bounce back in in Europe, although we did see a bigger decline there. But heading in the right direction. And we may even see this go positive in year-over-year terms if this the rebound in COVID cases doesn't continue to get worse. That's worrisome and suggests that this bounce back in the European Union is likely to fade pretty quickly in the next couple of months. Japan, excuse me, Canada, these are data through July. So again, the same kind of quick rebound. This will slow going forward. This will follow the same kind of pattern as the US, but their publication lag is longer on their data. So these are data just through August, whereas the US has reported data through September, and we'll have October data in another week and a half or so. Mexico, again, the same kind of pattern that you're seeing in much of the world. Still down from the pre-recession peak. One of the interesting things here is last fall, about October, there was a significant decline. And I went through the industry data, industry by industry in Mexico to see where this decline was. And it was basically motor vehicles and the industries that feed components into the motor vehicle industry. And I think this is the result of the USMCA shifting production perhaps from Mexico to the United States. And so Mexico was seeing a decline in production even before COVID-19, and then a big decline during the pandemic. Brazil is almost back to where it was before the pandemic in terms of industrial production, but that's not saying much because they're back to basically where they were at the very bottom of the Great Recession in late 2008 and early 2009. This is probably the worst performing large economy in the world over the last decade or so. This is not a strong economy. This is my forecast for around the world. GDP down about 4.5% this year, up 5% next year. Everyone's down this year except China, and then everybody is rebounding over the next couple of years, and then growth decelerates after that strong bounce back next year. Similarly for industrial production, this is a broad measure of industrial production that includes mining. So oil production is in here. That's one reason why the decline in the US is as big as it is, and why the bounce back next year isn't as big as you might hope it would be. That's because with oil prices where they are and with the drilling rig count down, we're not going to see a big rebound in oil production, which means industrial production and mining does not bounce back, and that keeps total industrial production down. The Middle East is going to endure a similar impact because they're so dependent on oil and gas production. So to sum up, this has been the deepest recession since the Great Depression. It's also been the shortest recession ever. To economists, the recession's over. To non-economists, it won't be until we fully recover, which probably won't be until early 2022. Although the strength and timing of that recovery depends on things that an economist is probably not the best person to address, because it depends largely on medical breakthroughs, specifically when we get a vaccine or an effective treatment. The treatments, at least so far, seem to have worked on President Trump over the weekend. Maybe we'll learn something from that, and we'll be able to apply those treatments more broadly and get the death rate down, get people recovering more quickly, and if people are less afraid of a severe case, they may be more willing to go back and resume normal activities, and the economy will pick up. But barring an effective treatment, we're still waiting for a vaccine. And the one thing that I would point out how this differs from most recessions, in most recessions, everybody loses. There are very few counter-cyclical industries. In terms of the stock market, there are very few negative beta stocks. This time around, though, there are winners and losers. So it's not, they say at a crisis, all correlations go to one. This is the exception. In this particular crisis, the correlations have not gone to one. Since we're coming up on election, I'm going to close with H.L. Mencken again and give his definition of an election. Maybe one of these days I'll be less cynical, but that's sort of the way politics has me feeling right now. And with that, I'm going to close. Again, if you want a copy of my slides, please email me and please check out my website.
Great, thank you, Robert. Why don't you leave that slide up so folks will know where to find you, and we'll just leave it up there. So we've had a few questions come in, and I'll encourage you that if you have questions, please type them into the chat window, or if you're inclined to want to ask them, then raise your hand so I can call on you. If you're ready, Robert, I'm going to give you a couple that have come in.
Okay.
So one of them is, and I've been discussing it a little bit back and forth, that a lot of the damage of this downturn has been deferred because people have been able to put off what they have to pay, such as forbearance on mortgages, right? Or not paying on your rent, or at least you can't be, evicted. And now those are all coming due. We don't see that extension happening. Maybe something will happen, but boy, it's been a long time. So now when that bill comes due, do you see this change in anything? Is there a dip that happens because of this?
I don't know what mortgage companies and landlords are going to do. So far, the savings rate is very high. People, because of the combination of the $1,200 checks and the enhanced unemployment benefits and PPP, actually have more money, and they've been saving it. So, the forbearance is supposed to be for people who really need it. We'll see about that. I think there are probably people who have money and will be able to pay it back. Others, though, yeah, it's going to be tough if we don't get an extension of stimulus. And the difficult thing about enhanced unemployment benefits is there are labor shortages in some industries. They can't get workers because those workers are getting so much in enhanced unemployment benefits. That's a problem even with the $300 enhancement that comes through President Trump's executive order. And yet we need the stimulus to the economy. And the problem is the state unemployment insurance systems can't handle putting in a percentage of income and say we're going to have a 70% replacement rate. We're going to replace 70% of pre-layoff earnings. All you can do is add a fixed amount. These systems were programmed in COBOL decades ago, and the states at least say they can't quickly change the system. So that's why we ended up with a $600 kicker, which means some people are getting way more than they would earn working, which really messes things up. So I don't know. It would be great if some tech company would come in and say, look, we can reprogram your system and get this working. And in a perfect world, I think the federal government would take over unemployment insurance. And they would set a replacement rate as a percentage of wages that was dependent upon the unemployment rate. So maybe it was, say, 70 to 90% of pre-layoff wages when you're at 10 or 12% unemployment. and 40 or 50% when you're at 3.5% unemployment, and you really shouldn't be getting unemployment insurance benefits very long because there are jobs out there. But no one's listening to me right now. I wrote my senator and got a form letter back in return. So at least I tried.
Yeah. Well, that brings a follow-on question, which is, there's also a bill coming due for all of these state and local and county taxes have gone away, right? So there's been a lot of tax not paid, never going to be paid, and coffers are kind of empty. What do you see coming from that?
Yeah. See, that's the big difference between state and local governments and the federal government. The federal government can print money. So it can run huge deficits. The Republicans don't want to bail out states that are just mismanaged their pension systems. But state and local governments really need some aid right now. So, hopefully they can reach a compromise where there would be money going to state and local governments, but they would, ring fence things so that they couldn't be used for bailing out pensions unless the pensions make some real big reforms. My idea of making of federalizing unemployment insurance, the other side to that is the states could then take the money that they're using for unemployment insurance right now and use that for other purposes. So that in a sense would be aid to the states. I'm sure they would gladly let the federal government take over unemployment insurance.
Yeah, absolutely. Please take this house and repair it, right? Let me flip that. So here's a perspective question. Looking at that data for the near zero interest rate offered for as long as you're now telling us into 2024, has there ever been a time when money has been so inexpensive for as long as it has been?
Well, just in the last decade after the Great Recession, it stayed near zero for about 6 years, I guess. I don't have it in front of me now, but we're just repeating that. So we're doing it again. There is a really interesting paper by two economists at Princeton, Marcus Bruermeyer, who's a professor, and Jan Kobe, who's a graduate student. And they came up with this concept called the reversal interest rate. And they argue that when interest rates get below a certain level, cutting interest rates actually slows the economy rather than speeding it up, rather than stimulating it. And they argue that on the basis of bank profits, that at some point interest rates are so low that it's not profitable for banks to make loans. I think you can get there another way, that if you think right now, the federal government is an enormous net debtor. Well, who's on the other side of that? The private sector. So the US private sector, the household sector, is an enormous net creditor. So when interest rates go down, the household sector gets a lot less income. And think in terms of risk averse, especially elderly people who don't put money in stocks and bonds, they put it in a bank. So the Fed's cutting interest rates, they're thinking in terms of those financially astute investors who have their money in stocks and bonds, and they're thinking stock prices are going up, bond prices are going up, people are better off, they're wealthier, they're going to spend more money. Meanwhile, people like my late father, who had planned on living off of interest income after the last recession when interest rates were zero, didn't get any interest income, so he had to draw down the principal, and we ended up having to sell the family farm to pay for his care. And I don't think the Fed gets that there are plenty of people out there who planned on living on interest income who can't anymore, and who've had to draw down the principal, and eventually they're to the point where they're just living on Social Security. I did hear from another economist with a major insurance company that's based in Switzerland, and they looked around the world at countries based on demographics, and he pointed out that in Italy was to the point that lower interest rates actually slowed the economy because there were so many old people living off of interest.
You know, that it really is fascinating when you think about where the money flow goes. And, you know, I've lived long enough to remember when a certificate of deposit could net you 12 or 16%. Right? It's a long
I
time ago.
remember in my early days at Conoco where some of my coworkers could get more in the fixed income piece in their 401k than their credit cards were charging them. So they were maxed out on their credit cards so that they could make bigger 401k contributions.
Yep.
Those days are long past. But, you know, I always thought people who think that low interest rates are a good thing are implicitly making a value judgment that borrowers are more deserving than savers. And I'm not sure I would make that value judgment.
Right, right. Yeah, there is a cost to everybody for the transaction at all, right? So it can't go to zero without somebody being harmed. Fascinating. Okay, I'll make one last call for anyone who would like to reach out and ask a question. I think, Robert, I feel a little better. And maybe that's only because I feel like I've seen some facts and they make some sense to me. And while you're telling me I need to hang on for about another year, I could probably do that now because I can see where we've been and kind of where we're going. And at least in our world of B2B, we're making it work okay, right? If we were all in the restaurant business, I think we'd all feel pretty crappy. But you know, maybe we're not all in the restaurant business. So
yeah,
that.
This recession has been more, I guess you could call it asymmetrical in its impact, that, you know, it's the restaurant industry, restaurants and bars and their employees. And maybe people in travel and entertainment more broadly, but disproportionately bearing the impact of this. And, you know, if you work in a manufacturing plant, now in a few of them, like a meat packing plant, you're crammed together and it's not safe. But in a lot of manufacturing facilities, you're spaced out enough, you can operate safely. If people are buying those goods, this really shouldn't have much of an impact after that initial panic and shutdown that we saw. So very, very different between the goods sector of the economy and the service sector.
So I'll remind everybody that you've got this newsletter that's out monthly that's reassuring you every month. And you can go and visit there. And as Robert has said, he'll extend it through 2021 for you. And I'd love to have you come back in a few more months, Robert. Maybe we could, like at the first of the year, come back and look again and see how things are going, because these snapshots have been very helpful for us as we learn, you know, for the next time.
All right.
Great. All right. Thank you, everyone, for joining us. And again, I'll make sure you write down Robert's email and his website. And we'll see you tomorrow for Amy Balliette and visual communication. Thanks. Bye-bye.
Bye.